Hello everyone. On behalf of AKC Capital, we are glad to present another interactive series on the financial markets and the impact of regulations on our industry. Extremely glad to present today Mr. Akhil Chaturvedi, Chief Business Officer with Motilal AMC, who will be guiding us in this discussion. So,
Thank you.
Thanks a lot for your time.
Thank you, Aditya. Thank you so much for calling me out here, and congratulations for your new venture. Right, wish you all the best.
Thank you so much. So Akhil, I thought we'll have questions. There are four key pointers which we have. My first question is really on the active and passive funds. So, in your view, what is the AUM size of the active and passive funds in India, and how do you see the market in the next 5 years from now? And if I may add, as an extension to this, assuming that the growth rates are significant in each of the categories, how can a distributor and a product manufacturer leverage this opportunity?
Yeah, so thank you, Aditya. I think it's a very important and a very relevant question. So if you see over the last several years and decades, industry has grown quite significantly. Obviously, active side has grown far faster than the passive, but in the last few years, we have seen phenomenal tailwinds on the passive side also.
Yeah.
If you see the overall AUM of the industry now is about 40 odd lakh crores approximately.
Right.
And if you break this into equity and debt, then active equities would be about 15.5 lakh crores.
Right.
And we have 7 lakh crores in passives.
Okay.
Within passives, we have ETFs and we have index funds. We have seen greater contribution in the ETF side, more specifically because of a lot of institutional participation through the EPFO.
Yeah.
So that's been a huge delta out there.
Yeah.
But in the recent past, we've also seen a lot of traction now, which is getting built on the index funds as well, because retail investors, HNIs, family offices, they are incrementally preferring to put money through the mutual fund route. It's far more convenient to invest.
Right.
So as you can see that roughly 40% of the equity AUM is now passive, right? So certainly passives are coming of age. I would say we are still in nascent stage, and we have many more years for passive to catch up with active, because India continues to be a market which can deliver a lot of alpha. Right. So that part of the market will grow at a faster pace. Let's say we assume that grows at about 20% or so. Passives also will grow at about 10-12%. So both will grow in line. But certainly industry is doing a lot of work in promoting passives. A lot of new ideations, innovations in products, which is happening in the recent past. All of these things will aid to get phenomenal growth in passives. Now, there's this debate about active versus passive.
Yeah.
The way I would like to put it is that we should look at active and passive.
Active, okay.
Right. So when an investor is investing money, essentially is trying to diversify his savings into multiple asset classes to diversify the risk, right?
Yeah.
So we'll stick to equities, and within equity, yes, as I said that since India is an alpha market, there has to be a reasonable allocation towards active funds.
Right.
But it will always help, or it will help to have some mix or some allocation into passives as well, right?
Yeah.
We have started to see the change in trend from the large cap category perspective.
Okay.
Because active large cap funds have underperformed the markets, right? Or
Yes.
it's been, there are patches when it outperforms, there are patches when it underperforms. So clearly that is one segment where we have seen a lot of money going in the passive side, which is the large cap category.
Yeah.
Even the active managers, broadly in fear of underperformance or trying to be in line with the market, tend to become more benchmark hugging.
Yeah.
Right? And try to be in line with the market, right? So in doing that, obviously, at least in the near future, past, we have seen that index has done or markets have done better than the large cap. So that is where we have seen bulk of the volumes now moving.
Right.
Last couple of years, markets have been extremely challenging since 2018, I would say, where in bouts you will see that markets get polarized.
Yeah.
certain sectors are dominating returns, and if active managers are under allocated, not allocated in those sectors,
Yeah,
those stocks,
absolutely.
those themes, then the underperformance starts to come.
Right.
For example, Adani as a group, I mean, just to give you
Yeah,
a small
yeah.
example, if active managers were not owning, and many were not owning, and Adani stocks went up 4-5 times,
Yeah.
that led to underperformances.
Yeah.
So in the recent past, we have seen active underperform, and that is also now leading to more curiosity towards passive. I think both are very, very relevant in a portfolio. The way I would like to put is that treat passives also as any other mutual fund, and there will be times when your passive funds will be doing better than active, and there will be times when active will
Yes,
be doing better than
absolutely.
passive. I've done some analysis on this. What we have seen is that the portfolios are divided into multiple market cap buckets. You have a large cap fund, then you have a flexi cap fund, then you have a mid cap fund, then you have a small cap fund.
Yeah.
So the more you keep going down towards the market cap bucket, you will see that the alpha keeps going up.
Okay.
Right. So the more you are getting into funds where large cap allocations are higher,
Yeah.
the chances of passive doing better will be higher.
Right.
Right, and the more you keep going towards lower end of the market cap bucket, you will see that active will do better than passive,
Yeah.
because there active managers are trying to hunt for good companies, high growth companies,
Yeah.
typically index agnostic, outside the index, very high active ratios in the portfolio, and that leads to outperformance.
Yeah.
So we've started with large cap.
Yeah.
If you look at flexi cap, multi cap category, maybe a 20% allocation in that category, you buy a Nifty 500.
Yeah.
Right, you go down to mid cap, maybe 10%, 15%, you can buy a mid cap on 50 index.
Yes, yes.
Lower down, so you have small allocations depending on which bucket you are investing, and what is the market cap allocation in that bucket.
Great.
So that is very simple part. The innovation part is where people like us are trying to do a lot of work, is trying to create products where there are new opportunities which are coming up, like factor strategies, right?
Right.
Now this is a very big market globally. It's a $3 trillion plus kind of market.
Right.
We have started to bring or introduce a lot of products on the factor side. Essentially, they are passively managed, but they follow certain factors.
Yeah.
So for example, momentum strategy is one factor, value is one factor, enhanced value is another factor,
And
right? Volatility, low vol. So there
Yeah.
are a lot of combinations depending on which market cycle we are in. One can take advantage of investing into these products and take the momentarily advantage
Right.
which the product is providing. For example,
Absolutely.
today if the markets are extremely volatile, there is a factor fund called low vol.
Yeah.
So one can clearly get into that fund, take the advantage, and keep rotating with the market cycles. So innovation, new ideations, plus your plain vanilla funds. I think all these put together, incrementally more and more interest coming from investors will lead to a reasonable good growth rate
Right.
for passive. And like I said, active is here to stay
Yeah, yeah.
for
long.
for many years,
Yeah,
I
yeah.
think. So both are very, very important. Both are very, very relevant.
I think interesting perspective, and I think the key words which really came out is both have their own, part of the asset allocation for investor portfolio, whether it's
Yeah.
active and passive. And then, another interesting point you brought out is that, the more you go, you look at the bucket, and when you have a higher volatility going down, along small and mid cap, I think you also have the chances that there will be an alpha.
Yes.
And there's a lesser probability in,
Right. Right.
I think.
Right.
So I think clearly asset allocation, looking at the volatility, factor investing, these are the key themes which are emerging and which are important in terms of, for our clients.
Absolutely.
So two more questions in the same category, and then I move to the next set. Is that I think there's a constant debate going on for active passive funds, in the industry, and you touched important aspects there. How do you see the investor preference, especially for retail or HNI clients, towards these funds changing over the next 5 to 10 years in a country like India, emerging market, and international funds which have really caught up over the last couple of years? How do they fit in these categories?
Yeah, so I think in the retail HNI segment, we have seen phenomenal growth on the international investing side. Huge growth, I think, since 2019.
Okay.
Phenomenal appetite, which is a very welcome change because, again, going back to financial planning, asset allocation, risk management, when you're investing in equities, it makes sense to do some investing or some diversification in the markets outside of India.
Yeah.
US is there, Europe is there,
Yeah.
emerging markets are there. So that's a very, very interesting and a welcome change in the way investors are thinking, and it makes a lot of sense to diversify your portfolio, some part of your equity portfolio outside of India. Like I said, that the growth was so fierce that we've hit all the limits. Right, so industry had a limit of $7 billion
yeah, which was
frozen.
reached,
Most of the
yeah.
AMCs, including ours, had a limit of $1 billion that is also frozen.
Right.
That limit has not opened up, and we hope it opens up soon because in the interest of investors, I think this part of diversification is very, very important. There is a huge opportunity, and once the limits will open, I'm sure this bucket will also grow very, very fast, right? So,
Absolutely.
so we are grappling right now with the limits. Certainly, it makes sense, but the opportunities are very, very limited, right?
Okay.
So, so that's on the international side. On the domestic side, I think two parts we have seen growth. One, we have seen investors or young investors, early age investors who just got into working population or
Right.
mid-age, and family offices, super HNIs.
Right.
Two segments,
Okay.
right? So in these two segments, we are seeing a reasonable amount of tailwinds for the passive funds. So the retail investors who are young are coming through the digital channels. So
Right.
all the digital entities which we all know about,
Yeah, yeah.
a large part of passive investing is happening through those channels.
Right.
And HNIs, institutions, corporates, they also from time to time try to take tactical benefit. And let's say if an investor is very, very bullish about banking sector, they want to play pure play banking, right? So then they will choose an index fund, come into banking, make money,
Yeah.
book profits and move out. So we are seeing that velocity in the HNI family office segment, including corporates, selected corporates.
Right.
And retail growth is happening through largely the digital channels. So
Digital
there is where
channel.
we have seen two pockets where growth is higher than the rest of the investing population.
Okay.
But see, eventually, it's all about performance, right? So
You need the returns.
So eventually, wherever investors will see performance,
Yeah.
You will see the polarization of assets also will go there.
Yeah.
So if Nifty 50 index was doing better than the other large cap funds, clearly we saw that Nifty
Yeah.
50 index became very, very large.
Yeah.
So it's going to be very interesting. We have to see how active managers do, how they stack up in terms of
Yeah.
overall performance, what kind of alpha rankings.
Yeah.
But eventually, money will chase performance.
Sure.
So if passives, let's say Nifty 500 broadly does better than the most of the multi-flexi cap funds, then obviously money will chase the Nifty 500 fund.
Yeah.
So that is something we have to wait and watch out for. But like I said, I still feel that if investors are coming for long term, let's say 10, 15, 20 years and more,
Yeah.
Clearly categories below the large cap category, in such time frames,
Yeah, yeah.
there will be alpha, and maybe in short durations, there
Yeah.
could be anybody's guess. So large amount of growth will come on the active side, but in between you will see opportunities where people will try to take advantage. So it's
Yeah.
an interesting space, but we are far from reaching where the developed markets
Yeah.
have gone, right?
Yeah,
So
yeah.
we cannot compare right now with US.
Still a long way to
Oh,
go.
There's a very, very long way to go. We are a very young country. We're just about $3 trillion.
So
$3.5
easily another
trillion.
15 to 20 years before we at least have some change.
I would say at least 10 years. I mean,
At least 10
At
years.
least 10 years from here, because this is a country of entrepreneurs. Last few years we have seen so many new entrepreneurs getting into the listed space, new ideas, new businesses, and young businesses tend to deliver higher growth. It
Yeah.
takes some time for them to come into the index. So by the time these young companies, become large enough to come into any kind of an index,
Yeah.
and if active managers participate in them, they will tend to do better than the index, right? So how do you generate alpha?
Yeah.
by trying to be away from the index, creating a portfolio which is away from the index,
Right,
with,
right.
with fundamentals which are better than the index.
Absolutely.
So better ROE, better growth, better valuations, and non-index hugging portfolio is how you're trying to outperform.
Sure.
Right.
Which brings us to the next part of our discussion is really on the alternate investment funds.
Yeah.
So this is a category which has like grown rapidly over the last couple of years, a huge spurt in industry AUM as well. So my question, the first two parts, and both are linked, is that we are anticipating new AIF regulations coming in financial year 23-24. That's what the industry buzz seems to be. So my question would be that what kind of regulations are we anticipating in this space broadly, and what would be your view in terms of these impacting the investor community as well as the product manufacturer, positive or negative? Some light on this would be helpful.
Yeah. So regulatory changes from time to time are always in the interest of investors.
Okay.
So nothing really changes for the investors. Things only tend to get
better.
much more easier,
Sure.
much more cost efficient from end investors' perspective.
Yeah.
So nothing changes for the investors per se. Now, if you see globally and if you see in India as well, regulators will always come in and try to plug things when they see massive growths, right?
Yeah.
So when the industry becomes very, very large,
Yeah.
then they will try and come inside and watch out for risk, watch out for cost, how better economics can work out, which is eventually better for the investors and for the future growth. We have seen so many regulations in the mutual funds over the last 2 decades.
Yeah.
Right? Every 2-3 years we see some amount of
Some kind of
regulation changes happening on how the funds are getting managed, how the risk is getting managed, how the pricing is getting managed. So the TERs are also getting under review every now and then as the industry is scaling up, right? But that hasn't led to slowdown of the mutual fund industry growth.
Yeah.
In fact, with every regulatory change, the
It
industry
has-
has only grown multiple times.
Yeah, that's a
Right?
good example.
So, so I think regulatory changes doesn't really mean that it is disruption and it will really bring the industry to go into a slowdown mode. That will not happen, right? So is the case with PMS, which used to be very, very small just about 10-11 years back. Overall industry size itself was about 30,000 crores. 10 years we have seen 30% compounded growth. The industry is now 3 lakh crores.
Yeah.
So with this kind of size, regulators came inside. We saw some changes in 2019 where upfront commissions were banned.
Yeah.
We moved towards all the right practices at that point of time. They have also now created, just like how we have AMFI, which is working with the industry closely. Regulators have created APME, Association of Portfolio Management Industry, right?
Okay.
So APME has got created, which on a day-to-day basis will work with the PMS manufacturers and bring about the required changes, right practices to ensure that investors are protected and the industry goes into a long-term
So something
growth.
similar could come for AIF as well? Similar body?
Let's see. Again, AIFs are so AIFs are it's a different animal. I'm sure at some stage it will come. Whether APME itself becomes a body for alternates, I don't know. So we'll wait and watch for that.
Okay.
So we have seen regular changes in the mutual fund structure. We have seen changes in PMS structure, and we expect some more regulatory changes on the PMS as well.
Okay.
Now that AIFs as an overall category, including category 1, 2, 3, has become significantly large with almost 7 odd lakh crores across all these 3 categories. Regulators have now come inside and they are trying to see how some of the things can be done in a way which is better for the investors, right? So we expect that the upfront commissions part, which is the first thing which gets comes into the radar. So that part, at least the white paper is out. We are yet to see the regulations, but that's something on the radar, right? For now, for category 1, 2, it will be treated differently. For category 3, it will be treated differently. So regulations will come. It will not really significantly change anything for the investors.
Right.
For the asset management companies, they are essentially doing the fund management job. So they'll continue to do their fund management job. But yes, between a very important link between investors
Yeah.
and asset managers is a distributor.
Yeah.
So for distributor, obviously, from upfronted income goes into trail income. In a way, both are good,
Yeah.
right? So, but yes, one has to get
Yes.
aligned.
Yeah.
And distributors also are now very intelligent, so they
Yeah, yeah.
understand that. I mean, you grow with the investors,
Yes, yes.
right? So if you are on trail commissions,
Yeah, yeah.
then let's say you bring in an investor at 10 rupee today, in 10 years 10 rupee becomes 40 rupees.
Yes.
Then you are earning trail on 10 till 40.
Till
right?
40,
So you
yeah.
participate in the growth of the
Of the-
investors,
yeah,
and
absolutely.
therefore the distributors also will be extra choosy and careful in terms of which manufacturers can give good growth,
Yeah.
good wealth creation.
Yeah, right.
So everybody gets aligned.
Yeah,
I think
part of the normal
manufacturer,
process.
distributor, investor, everybody is aligned that make money as performance comes. And if there's
Absolutely.
no performance, there's
Yeah,
no
yeah.
money, right? So,
Absolutely.
So coming back, just to summing it up, is that it's fine. Maybe sometimes regulations are good. Sometimes it comes a little early.
Yeah.
But that's all right. I think India as a country is very, very young. The investors have now started to think very, very differently in terms of asset allocation.
Right.
From a fixed income kind of a market, we are seeing that shift from fixed income to equities to risk.
To risk.
Right. So as the per capita is growing, as the savings are growing, as number of HNIs are growing, number of family offices are growing, as wealth is getting in general getting created in this country, people will want to have new options, new ideas, differentiated products,
Yeah.
innovative funds to take
Absolutely.
slightly extra risk. So all three segments will grow exclusively.
Fair
So mutual funds is the best platform. It will
Absolutely.
continue to grow.
Yeah.
PMS offers certain benefits. So those who want those benefits will go to
Absolutely.
PMS.
Yeah, yeah.
AIFs give you exposure to venture capital funds. It gives you exposure to private equity. It gives you exposure to real estate.
Yeah.
It gives you exposure to long short funds.
Yes, yes.
And plain vanilla long only funds, right? But fund managers have the ability to create that boutique portfolios,
Yeah,
differentiated
yeah.
portfolios than plain vanilla mutual funds.
Yeah.
And that attracts
That
at
attracts.
least the HNI segment.
Right.
So overall, I think there's going to be phenomenal growth.
Good, good.
I think 20 years back we used to say that this industry is a sunrise industry.
Yes.
I'll say that today also we are sunrise industry,
think
and
that's
after
a-
10 years also we will be sunrise industry, right? So
And I think that kind of shares that what growth potential
Huge
lies
growth
ahead.
potential.
And I think if I were to just kind of summarize what you're trying to say, is I think the regulatory intervention and the framework is a continuous thing.
it's a continuous.
And the industry will eventually adapt to it.
Absolutely.
And the funds will continue to grow.
Absolutely.
I think that's a key
No-
takeaway
no
coming in
no
here.
doubts
I
about
think thank you so much for those inputs.
Thank you.
Which brings us to the other aspect, and extension is obviously the mutual fund industry. Obviously, that again has grown leaps and bounds
Yeah.
over the last 2 decades. So I think one key regulation which is come in there is about with SEBI, and again it's a white paper, and we need to see how it pans out from 1st April. Is about the total expense ratio of the mutual fund. So the proposal is that across a category of mutual funds, the TR is going to be uniform. Yeah. So my question would be that again, what would be the impact of this, on the investor as well as the AMC, and how do you see that going forward?
Yeah, so again, like you said, there is a paper which is now under
Yeah.
consultation on the overall mutual funds TER. So again, as I
Specific
said,
to the category.
yes,
Yeah.
yeah. So basically, what is essentially what they're trying to do or propose is that earlier what was happening was that TERs were dependent on the size of the funds within a AMC.
Within an AMC.
Right?
That's
so
right.
small size funds, the TRs used to be higher, and higher the size of the fund, the TRs used to come down.
Yeah.
Now they're trying to make this uniform in the category itself.
Okay.
Right. So all
Yeah.
equity funds will be treated as one pool,
Right.
one bucket.
Yeah.
And depending on the size of equity assets for that particular asset management company, the TRs will be changing. So, for example, what is proposed is up to 4,000 crores, the TR could be, let's say 2.4%.
Right.
4,000 to 10,000 crores, 2.25, 10 to 20,000, 2%. So, overall pool, as it keeps growing, the overall TRs will start to fall down, which is where the economies of scale comes, right? So, higher the size, lower this thing, right? So, so that is the one big change from scheme specific differentiated TRs to pool based overall category AUM.
Okay.
Right? It simplifies things. TRs become uniform, not only for one AMC, but across the industry, there will be a lot more uniformity.
Yeah.
Yes, it will have some advantages for AMCs with lower assets under management, because they'll have the potential to
kind of
have higher TR, but large AMCs, especially the ones over 50,000 crores, will have some impact on the revenues. So overall, it is I think just rationalizing the cost. So that's one part. The other thing they are saying is also that a lot of incidental transactional cost also should be part of the TER. So earlier, the transaction cost was over and above the TER. So the trades which were happening within the fund were, the charges for the trades were over and above.
Over and above, yeah.
The GST part on the management fees was over and above. STT was over and above. So there was certain cost, maybe 20-25 bips, over and above the actual TER, which they propose to bring within the TER. Now there is a to and fro discussion dialogue which is happening. I'm not going to get into the regulation part.
Right.
But the whole thing is that regulator, the way I understand, is trying to say to the manufacturers is that be cost conscious, try to keep the costs as low as possible, and the entire the two stakeholders, which is the AMCs and the distributors, have to work within a certain kitty which is available.
Right.
Like I said, as the industry will grow, we should expect, regulator to come in and make new proposal in the interest of the investors, in the interest of right selling, all of these things. So we'll wait and watch. There are several more things which are under consideration in the way how B30 is happening. And so they have done a lot of study on this. Industry has also given their suggestions, recommendations. So we'll wait and watch.
Absolutely. No, I think thanks for your input, and I think, as you said, this is an evolving space, and we'll keep anticipating. But you rightly touched base on certain key aspects which could change, and I could understand that. But I think one clear takeaway which is coming from this piece, and which I keep discussing with all the AMC community and on the product matching side, I think clearly the volume and scale is the game, if I can take away the two pieces.
And this is coming high volume, low margin business.
Yeah, so that is clearly coming forth in your conversation as well, that I think as we look over the next 5 to 10 years, whether it's, which I'm just kind of inferring from what you're just trying to say, is that whether it's from the distribution side or from the product manufacturing side, while the regulator is looking at the interests of the investors, but overall there'll be a limited pool in which both the distribution community as well as the manufacturer will have to work, which means that clearly the volume and scale is very, very important. And I think on the distribution side, the distributors who have, do not have significant AUMs would come under pressure over time. Because obviously, if you're looking at it from a profitability perspective or any enterprise, you need volumes to
and volumes are there. Volumes are there. I mean, one has to go out there and get the volumes, right? I mean, like I said that.
So it's I think it's a.
I've made I mean, the data is not extrapolated to the entire distribution chain, but I do a lot of seminars for the MFD segment, right?
Absolutely.
So I had given them this data that MFDs have become very large component of overall equity assets, almost 40%, right?
40%.
you are also an MFD for that matter,
Yeah.
right? So now this category, if you see the total out of 15 lakh crores of mutual fund AUM, about 6 lakh crores of AUM is MFD AUM.
Which is quite a
This
lot.
6 lakh crores, if you don't do anything, compounds at 12%,
Hmm.
would become 16 lakh crores anyways in the next 10 years.
Yes, yes.
Don't do anything.
Right.
Right now, obviously, you will do something.
Mhm.
Right. So as the economy will grow, there is a savings rate, and then there are people who are saving.
Hmm.
So you will have new corpus which will keep coming inside. So the potential for the MFD community is phenomenal. Like I told you, from 6 lakh crores to 38 lakh crores. I think, and then I was talking about unique investors, which is just about 3 crores. We may talk about multiple folios, which would be 8 crores, 9 crores, but 3 crore unique PAN numbers investing. So you can imagine that 3 crores going to, even if it doubles to 6 crores,
That's
what will happen, right? So I feel that in next 10 years, this industry itself from 40 lakh crores will be upwards of 100 lakh crores. Equity AUM of 15 lakh crores might be 40, 50 lakh crores, right? So it's huge, and we have just about 100,000 mutual fund distributors, out of which 20,000 are relevant.
Okay.
Right? But we want this other 80% also to be relevant, right? So, and the other thing, interestingly, that it's not only about the large metro cities where investors are investing. Now, this also, we used to have B15, then it became B30.
B30.
Right?
Yeah.
So, the investor population is actually growing in the smaller markets much faster
Much
now,
faster.
right? And it will grow even more faster.
Okay.
Right. So the growth rate of the per capita growth rate in the smaller town cities will be much more higher and rapid. So a lot of consumer companies you would be knowing it are incrementally investing a lot of money in the smaller towns. If you look at levers, they are doing more capex in the small towns. If you see Maruti Suzuki, they are going more down, right? So here the markets are saturated. So incremental growth will come down. And we are a huge country with 140 crore people, right? So 140 crores, even if you take 40 crore people who are in the working, and within that we have 3 crores. So I think sky is the limit. So it's not an industry which will grow for next 10 years. It's a, like we say, that stock markets in India will be very, very attractive for the next 3-4 decades. So similarly, our business also will be very, very high growth for the next 3-4 decades, right? So, and a lot of work needs to be done by you, me, regulators, all the stakeholders to do a lot of investor education and get them in the right products.
Absolutely.
Everything is important. Fixed deposits also important. Fixed income funds also important. Equity is also important. AIF is also important. All these things are relevant for different populations. So I see that there's a huge scope, and it's a sunrise. So coming to your question, I think all MFDs should spend a lot of time in doing investor awareness programs, more prospecting, and they have to work hard. Otherwise, margins are only getting are going to shrink. Right. So that can only be compensated through 2x, 3x, 4x volumes.
No, I think that's an interesting and good numbers. From statistics in terms of growth, and thanks for sharing that. I think I'm sure those are good to hear in terms of where the current status is. And I think the key takeaway which I'm taking from this conversation is that end of the day, as the market grows, all the key stakeholders, I think, whether it's the end investors, the regulator, the product manufacturer, the distributors, all have to end of the day work in cohesion.
Absolutely.
And in the larger good, create more awareness about financial inclusion, from financial planning, because that's ultimately the end goal which even the regulator and
absolutely
wants. So,
absolutely.
So idea is to do good work in the end and be very careful about small changes which impact each stakeholder. And I think that's part of the journey.
See, there is a saying, change is the only thing which is constant, right? So changes will keep happening.
Absolutely.
In short term, there will be some adjustments one has to do in the business plan, and think of the big picture. Have a 25-year business plan. Don't have a 1-year, 2-year business plan. Focus on investors. Focus on the right things for them. Ensure that they reach their goals. You will reach their goals automatically.
Great, and which brings to the the next topic, and which is core to Motilal Oswal Asset Management Company. So, what really is the investment philosophy of the AMC, and what are the key parameters, especially when it comes to selecting a particular stock and company? And if I may add to that, in alternate assets, what percentage of the corpus is, given by the promoters? The total. If I look at the total AUM that the AMC is managing in the alternate assets category, as an anchor investor, what proportion of the money is committed by the promoters? The reason for that question is that it's more about skin in the game.
Yes.
So I think that brings forth a lot more commitment from the AMC as well as they work in this space.
So thank you for that question. I think that's the easiest part to talk about our own organization. But so I've been in this company for 10 years, and overall I've spent 23 years, and I worked for 2 more AMCs. So clearly, this AMC is a very differently wired AMC, right? So our asset management business predominantly took birth out of passion of our chairman founder, Mr. Ramdev Agarwal.
Yeah.
His investing experience of last 40 years, from nothing, he created a lot of wealth by investing into equities. Apart from the growth of our business per se, his own, personal net worth, a large part of this was due to his investing in equities, being bullish on India, bullish on equities, right? Over the period of time, in his investing journey, obviously he started to follow Warren Buffett, started to go to Omaha for the AGMs, and started to get inspired to bring about his own style, philosophy, frameworks to do the right way of stock market investing, right?
Yeah.
And for the last 27 years, he's also been doing wealth creation studies.
Which is, I think,
Right,
we all
so,
like that.
yeah.
The every
Annual
year
wealth creation study every December. So every year for 2 months he isolates himself and gets into the research mode, and the work of that 2 months comes out into the wealth creation study, which is a paper.
Yeah.
Essentially trying to understand various tenets of equity investing, various frameworks of equity investing. And these 27 years of wealth creation studies helped us to create a well-coined investment philosophy
Yeah.
for us, which is the QGLP frameworks,
Okay.
quality, growth, longevity and price.
Yeah.
Right. So when you're investing in equities, obviously you're taking risk. It's a high risk, business, and certainly it's a very volatile asset class also. So Buffett says that there are 2 rules to investing. Rule number 1 is never lose money, and rule number 2 is never forget rule number 1.
Yeah.
Now, when you follow those rules, then obviously we want to invest money, we want to make money. At the same time, we don't want to lose money.
Yeah.
So to reach that, you need to focus on quality.
Correct.
Right. So if you invest in high quality businesses, your downsides will be limited, your upsides will be unlimited. So quality gives you the downside protection.
Right.
We are trying to, within the quality framework, trying to look at quality businesses with strong competitive advantages or economic moats, what you say. Very simply put,
Yeah.
there are a lot of things which goes into this,
Yeah.
and then run by a great management.
Right.
Right. So like Ramdevji says that good business multiplied by good management, 1 into 1 is equal to 1.
Right.
Right. Good business, bad management, 1 into 0 is 0. Bad business, good management is also 0. Right. So both have to work in line.
In line. Yeah.
Right. And especially in our country, with the kind of track record we have, obviously things are now changing. But often businesses don't fail. Management fail the businesses.
Yeah,
right.
yeah.
So this is 90% of investing quality.
Correct.
90% of the filtration process at our end happens in the first framework, which is quality.
Right.
But that part is done, right? So now quality is given.
Okay.
Then you have to make money, right? So you go for growth. So within this universe, we have to chase for companies which can grow faster than the average growth of the companies which are listed in the market.
Yeah.
Right. So let's say if the earnings growth, let's say hypothetically, if the earnings growth of the market or all the companies within the market is, let's say, 15%. So we are looking at companies which can grow more than 15%.
Right.
Right. So 2% more, 3% more, 4% more, or even simply put, we are looking at companies which can double their profits in 4 to 5 year time frame. So 15 to 25% of earnings growth, and assuming that as earnings growth or as profits will grow, market cap will also grow. So what is in your hand is getting the quality right, getting the management right, and getting the right earnings growth, right? And then you leave it to the market for it to give you the due valuation. So
absolutely.
quality and growth. Then we are long-term investors. We believe in buy right, sit tight.
Yeah.
Right? That's our philosophy, stated
yeah,
principles.
absolutely. Yeah.
So longevity is very important. So longevity of quality, longevity of growth, right? So that's the L check. Finally, at what price you want to buy QGL? So
Right.
quality, growth, longevity is the value side of the business.
Right.
P is the valuation.
Right.
Right? You may get all the three things right, but if you get the price wrong,
Right.
then you may not make money, or you may make money back-ended, and you may underperform for some time, right?
Absolutely.
So valuations are extremely important, and therefore a lot of work, a lot of frameworks within the valuation, within the P. There are a lot of things we do, like PE multiple is one thing, price to book is one thing, discount to value is other thing, price earning to growth. So there are a lot of variables we
That
try
is how
to
it
understand, because like Buffett also said that a good company doesn't know at what price investor has bought it, right? So if you
Yeah.
buy a great business at a wrong price, and if you don't make money, you cannot blame the business per se,
Right,
right? Now, so valuations, a lot of work goes, quality and valuation, right, and getting the growth as per your this thing. So those are the four simple frameworks. It may sound very simple, but
yeah,
there is a lot of work. We do scorings, and we do a lot many things. So those are the four principles which basically help us to create a universe and do stock selection, right? And then on the other side, we have very strong risk management frameworks, right? So basically trying to ensure that if we get a certain stock right, we make a lot of money. So at some stage, we need to book our profits and protect the returns in the fund. How do we cut our laggards, or how do we cut the underperforming stock? How do you diversify your portfolio in a way that you are not taking risk on the top side or the bottom side? So a lot of risk management principles also have been laid down. So selection and allocation, both sides, we are trying to be completely on top of, to ensure that we continue to get good ideas to invest early on, and ensure that consistency of performance is there through the risk management framework. So that's how essentially we try and do our investing. We are very, very focused on the equity segment, so we don't do fixed income.
Yeah.
So whether you buy my mutual funds, you buy my PMS, you buy our AIF, QGLP is the common thread between all the three vehicles. We believe in doing limited number of products. So essentially this philosophy will limit you to do too many funds.
Okay.
So you will find our funds into market cap buckets like large cap, mid cap, small cap, multi cap. That's it. Whether again mutual fund, PMS, AIF, these are the buckets you will find our products which are getting bundled up, right?
Okay.
And finally, to your question, skin in the game,
Right.
which is very, very unique out here again, and I think it will be unique in the world, where our promoters have committed almost 10% of our overall corpus, 100% of their investment, and 10% of our overall corpus.
It's
So
a significant number.
very significant, I think, and they started to do this very early on. So we started launching active funds in 2013, and 2014 onwards they collapsed their direct equity book, and they started to move all the money into our own products.
Okay.
So we started off with 300-400 crores in 2014.
Right.
This corpus has now grown to become 4,000 crores plus,
Yes.
out of which I would say 3,500 crores is in mutual funds,
Right.
because mutual funds is much more tax efficient and
Yeah.
liquid, and the remaining about 500 odd crores is in our alternate, which is PMS plus AIF. So each AIF we commit our own money. So we have 14 AIFs. We have on an average 15-20 crores in each AIF. So
Right.
200-250 crores in AIFs. I think similar number should be there on the PMS side.
Okay.
But mutual funds is much
core.
larger corpus, which is 3,500 crores, and this continues to grow
Right.
every year as the cash flows come to the promoters. The money is getting invested. So I would say that today we are 4,000. We started off with 400. So in 10 years it is 10x.
Yeah.
So in next 10 years, if this is 10x, then 4,000 will become 40,000 crores. So what my total AUM is will be only promoters AUM, right?
Correct.
The thought was very simple, that we have to keep the interest of investors and asset manager aligned. My portfolio cannot be different than your portfolio.
Yeah.
If I do well, you do well. If I don't do well, I don't do well first for myself, then I don't do well for you.
Sure.
You will still have a choice to exit out. We will be fully invested, irrespective we are doing good or bad.
Absolutely.
Right? So that's it. Equities, limited number of funds, QGLP philosophy, skin in the game. These are the principles we are working on, and look forward to.
So, thank you for your inputs there. And one of the things which I keep coming across from the investors and my clients as well is that what really is an exit strategy. So, while we looked at this framework, so maybe if you can just maybe take another 30 seconds and tell us that under what circumstances would you actually exit an underlying stock or a portfolio?
You're talking from
More from profit
stock perspective or
or
investors?
maybe let's say from a at the portfolio level.
Yeah.
What would be the one or two pointers which would whether it could, so for example it could be a profit booking, it could be some event based trigger.
Yeah.
Generally, what could be the exit strategies as
It's a mix of all that you have said.
Okay.
If I have to put it very simply,
Yeah.
if any of the framework of QGLP is getting disturbed, it is an exit trigger.
It's an exit trigger.
So let's say if the quality, for some reason, the quality is coming down, quality of the business itself is coming down,
Okay.
or let's say the management is not giving us enough confidence. So quality becomes reason of exit.
Any of the frameworks not
Yeah,
coming up
if
with
the growth comes down,
Again,
it's
it could
a
be a-
sell. If we are not seeing enough longevity of growth,
Yeah.
it's a sell. And valuations,
Got it.
right? So as simply put, but giving you some more finer details, let's say essentially we invest into some business at 100, it becomes 300, 400,
Yeah.
and the PE multiples become exaggerated, right?
Right.
So we have to take our profits.
We have
So
to-
what we have done is we have put caps on stocks.
Okay.
Right, so my maximum cap on a stock is 9%.
Yeah.
For some reason, if a stock crosses 9%, then there is a forced sell-off and
Yeah, yeah.
forced profit booking, you can
Right,
put it.
right.
And on the similarly on booking your losses or cutting the laggards, then what we are trying to see is when some company is getting corrected or the share price are falling, then what is the relative performance, and if the company is underperforming for 1 quarter, there has to be 50% off the table. There is 2 quarters of underperformance, then it has to be full exit. Unless there is a very compelling reason to stay on.
Right.
Narrative is very, very strong. It could be short term. So that the investment committee will take a call.
Yeah.
But we have actually defined all these, how to take profits off, how to cut the laggards, how to optimally diversify the portfolio. We have put all these frameworks hard-coded.
Which is okay.
Still we can make mistakes. Right?
I think that's
so mistakes are something which is part of life. So keep making mistakes, keep learning from them, keep improving, and it's a business where you learn every day, right? So you're never perfect.
Actually, thank you so much, Akhil, for your time. I think this was such a unique insight and perspective that you shared.
Thank you, Aditya.
And personally grateful for your time and sharing the perspectives of Motilal Oswal AMC.
Thank you.
And which then that concludes the session.
Thank
and
you.
As we conclude, I think one final view for our viewers. So thank you for your time as well, and we'll be soon back with another interactive series on the markets in our next discussion. Thank you so much, and thanks Akhil once again for your time.
Thank you.
Looking
Thank you.
forward to
Thank you
the
so
next
much.
one. So,
Thank you so
thank
much.
you.